Hello and welcome to the fundamental portion of the newsletter for July 26. Today we're going to be straying a little bit off the cryptocurrency path, but sticking with the theme of scarcity, and we're actually going to go over the very mundane, very boring pet rock, Boomer Bricks. And the reason that I want to bring this up is we've recently seen gold break above the US dollar all-time high, and I think this is a really, really important event that's occurred because it kind of highlights and underlines where we are in the macroeconomic cycle. And I just wanted to kind of touch on some of the drivers as to why I believe, a small portion of why I think this is going on and why I actually think it's a really, really important event. And something that we should all be paying a fair amount of attention to be honest, just to track how everything is going. And really, this is kind of my thoughts at the moment. I do have a gut feel that gold is going to suck the air out of the room before Bitcoin does. I think it's going to move harder, faster, and first. Somewhat similar to what we saw in 2019, where Bitcoin ran and everything else, all the altcoins, sold off next to it. Now, I don't think necessarily that Bitcoin will sell off to a great extent. I don't think that they're going to be that well correlated together. But I do think that everything else will basically be sold off and a relative scale. And this is an important thing to get a head around. Just because we're seeing it sell off in, not sell off in the US dollar terms, does not mean it's not being sold off in gold terms. And what this trade is really looking at, it's a outperformance trade. And the general gist is that every single person is underweight in gold. And there's been a number of commentators who've said similar. I know Dan Tepiero said recently in a tweet that everybody should have gold, and if you think you have gold, you don't have anywhere near enough. Everyone is underweight gold, and the magnitude of this, the magnitude of money that is required to actually correct that level of being underweight, is really why I think gold is headed for a very, very strong rally in the medium to near term. I think it is well and truly undervalued in the world. Now, fundamentally, precious metals and cryptocurrency are the same trade in a lot of regards. We're talking about scarcity being immensely undervalued. And what I really want to look at is who is actually buying this asset, gold in particular, and when. When are they actually buying it? And all of this is actually very important for the longer term. So really, it's all about the same trader being scarcity, and scarcity has been wildly mispriced, largely due to the fact that there's a zero yield on the pet rock and on Bitcoin as well. There's no yield that comes out of them. I think that there's very, very strong movements in the macro environment as to why having a zero yield is actually a positive at this point in time. Now, I mentioned earlier about things selling off, and this is a chart that's basically plotting out the Dow Jones. You can do the same exercise for the S&P or pretty much any asset, where the blue line is basically the Dow Jones priced in US dollars, and the gold line is priced in gold. And you can see that there's a very, very different pattern at play. You can see that back in 2000, versus gold, it essentially set the absolute high. It is the highest that the Dow Jones has ever gone in terms of pricing in gold. And when you compare that to the current market, it is very, very clearly a lower high on a very large time scale. We're talking about a decade-long time scale here. If you compare the exact same chart in dollars, we're talking about a raging all-time high, right? And you can see just by that pattern alone the degree to which dollars have been debased over that last 10 years as a result of quantitative easing and more or less injection of that money into financial assets like Dow Jones or SPX or the NASDAQ. So this pattern is important, and you can see that during this present crisis, whilst the NASDAQ may be at all-time highs, the S&P and the Dow Jones certainly have a very, very strong, what are they saying, one of the best rallies in stock market history off the March lows. They are very clearly being sold off versus gold. Now, that doesn't necessarily mean that someone is selling S&P and buying gold, but it does mean that gold is outperforming. And we'll look at some other charts that really hint that this is actually what's going on. So this one is the gold price expressed as a ratio of the S&P 500. So kind of the opposite of that gold chart we were just looking at. It's actually the inverse. And this is basically, this is saying that if you owned S&P, that's your denominator, what does the gold price look like? Now, I don't know about you, but if I saw an altcoin that looked like this chart, to me that's a screaming buy. Right? We have a 2-decade-long basing pattern, and it has just popped up above the 50 month moving average. And the last time that this happened, where we see the gold price break the 50 month moving average for the S&P, which had a 500% move over the next 10 years. Now, whilst 500% in crypto land may sound a little bit trivial, which is hilarious in its own regard, this is 500% over the S&P 500, which had a stellar run into the 2007-2008 crash. So within this, we are talking about a 500% move on top of all of the gains in the stock market. And this just gives you a bit of a scale of the level of the price increase, and the relative movement of the gold price. That when gold starts to trend, it really, really trends. It really moves very hard, and it goes for long periods of time. And you can see at the moment that we've only recently broken above that 50-month moving average, and that has traditionally signaled a very, very strong move from here on. So, there's a lot of stars that are starting to align on this front, that there is an asymmetric bet at play with the pet rock. And this is a extrapolated version of that chart plotted against a log scale, this going back into the 30s. And you can see that there's a number of these fractals that are played out over time. And you can actually see that when gold starts to trend, it trends hard and fast. And, our current level where we are at the moment is more or less down towards historical lows. And if you actually look at the current leg up, from a technical analysis perspective, we've had this leg off from the 2000s. We set that lower high, and now it's actually so that significant lower high on this front, and we're then starting to curl back up potentially for another rally. And when you combine that with the macroeconomic side of things, when gold trends, it really does trend in a very, very strong manner. And again, this is relative to the stock market. So, it's starting to express that store of value characteristic that gold is known for in some circles. And this chart here is then looking at a similar kind of funny ratio. This is looking at the gold miners, the GDX ETF, compared to the gold price. Now, miners in general, or gold equities, mining equities, tend to function as an alpha play over gold. When gold is being sold off, these companies are more, and you can think of Bitcoin miners in the exact same way. When gold is losing value or being sold off versus the dollar, or is an unfavorable investment, then the equities that are producing that asset are more or less going to decrease at a greater rate. Right? You don't really want to be holding a depreciating asset, and a gold mining stock who continues to have capex and opex costs, and the asset that they are selling is going down in value. They're not the best play. And the GDX is the main miners. I think the top 65% is the top 10 miners in the world. The GDXJ, or the junior mining ETF, during this same period, I think where the GDX lost something like 40-50%, the GDXJ lost 75 to 80%. So, really is following the path of altcoins there. It's kind of that leverage play that works both to the upside and the downside. And you can see in this chart that we've more or less set a significant double bottom. And again, this is starting to look like a strong trend reversal off a deep capitulation point. And again, we've bounced up and bounced off that 50-day moving average. And you're starting to see that there is in fact some momentum back to the upside now. And we are at the bottom of what could be a generational bottom. So not only is the gold price starting to look fairly strong, but the miners are actually starting to look fairly strong as well, coming from a long, stable basing pattern over the last decade. And in terms of a macro backdrop, this is a fascinating chart that I came across the other day, which is essentially a 700-year plot of all interest rates through various civilizations since the 1300s. And what's amazing here is that it's actually a 700-year downtrend through all different civilizations and populations and central banking and fiat currencies and things like that. We've had a generally decreasing over time magnitude of interest rates. And this is starting to say that we're now at the point where we're talking about zero to negative interest rates. Is this indeed getting to the end of sustainable fiat systems? And this is, through all of these periods, there's been empires and nations and things that have risen and crumbled and collapsed and risen back up, and transfers of power and things like that through history. And invariably, gold has kind of been that backbone to all of this. And it's more or less preserved purchasing power through this entire period of time. There's the saying of, an ounce of gold will buy you a fine suit no matter where you are in time. And to be fair, that's more or less true. And you can follow pricing indexes and things, and gold has more or less retained its purchasing power, whilst fiat currencies have been debased by almost every authority that's had control over them. So I thought this was a fairly fascinating trend, and we are kind of at a tipping point now where we are at zero and pushing into the negative realm. So we're in a fairly unique position in this entire chart, that we could be at the tail end, and something is probably going to change. And gold has been a constant through all of these different periods of time. So that's kind of the groundwork as to why gold is important in this instance. And speaking of negative yielding debt, how does 13 trillion of it sound? We're seeing a very, very strong uptrend in global negative issued debt. And for those who don't quite get your head around negative yielding bonds, I don't blame you. The notion is that you would give somebody money, lend somebody money, and expect them to give you back less than what you gave them. Normally, when you loan someone money, you expect some form of interest payment, which is what a positive yielding bond would be. In this instance, you are paying someone to take your money and then give it back less later on, which is, to be fair, is just pure insanity. And yet we're seeing an increasing volume of negative yielding debt around the world to the tune of $13 trillion. I think at the moment, if my memory serves, it's something on the order of 20 to 25% of global bonds are currently negative yielding. So, this is where gold with a zero, and Bitcoin with a zero yield, becomes very, very attractive in a world where we're talking about negative yields. And we have to remember that there's two types of interest rates here. There's the real interest rate, the nominal interest rate, which is how much the bond will pay you. If it's yielding 2%, you get paid 2% of your capital. If it's when you factor in inflation, if you're being paid 2%, but your inflation rate is 2%, then technically it's yielding zero, because whatever you get paid in interest is being eaten up in inflation. That's the real interest rate. Now, if we have interest rates, nominal, that are getting down into the fractions of a percent or zero, as they are around most of the world, and then you have a 2% inflation rate, suddenly you're actually at a real rate of -2, right? And if we have even higher inflation, due to the injection of capital, whether it be into financial markets or into Main Street by stimulus checks and things like that, PPP loans, you start ending up with a potential actual positive real a positive inflation rate, and therefore a very negative real yield curve for bonds. And within that, I would rather own something with zero yield than negative yield, is really where this starts to trade. And we've seen this play out through history in the past, where when real rates go negative, you start seeing gold and these other assets really start to perform. And the basis of the gold trend really is that cash is most definitely trash. This is the gold price in the bar charts compared to the M2 money supply. Now, for those who aren't familiar, the M1 money supply is basically what you would think of as cash. It's kind of cash deposits and checks and things like that. M2 then adds onto that additional things like money markets and various other monetized securities, where they're cash securities, so they're not quite as liquid as just paper cash or bank deposits, but they are more closely akin than a credit instrument or something like that. So it's kind of the broadest sense of the money supply. And you can see that in green, especially in 2020, there's been a lot of printing going on through the entire history, and you can actually see the trend. I mean, as more fiat currency is printed, the gold price tends to rally, and again, when it rallies fairly strong. So this kind of puts into perspective the scale of the scarcity trade, And most definitely, we've seen a strong correlation between M2 and the current price in gold. Now that it's breaking above all-time highs. So the question comes: who is actually buying gold? You know, we in the crypto space tend to think of it as boomer bricks, but who's actually buying? And my thesis is rapidly converging on literally everyone. We've got, you know, everything from pension funds, institutions, retirees needing to preserve their wealth. As price starts really moving, you're going to see speculators and momentum traders kicking into this. All of these people are severely underweight gold. Now, at the end of this presentation, I've got a resource list, and some of these snips are from, in fact, most of these snips are from a number of those. These ones in particular are from one of Grant Williams' talks. And on the left-hand side, he's basically saying, and this was in 2016, so it's a few years outdated, but the principles remain the same. At that point in time, most of the pension funds were 0.15% allocated to gold and gold equities, which is a very, very small allocation. Now, he had the thought experiment: what would happen if those funds doubled their allocation and needed to inject another 0.15%? That would be something to the tune of $100 billion. Now, for context, that's roughly a third of all Bitcoins in existence. So, you know, we're talking about, in our sense, a lot of money. In Wall Street sense, it's not that much money, relatively speaking. When you starting to look at, you know, tens of trillions in various equity markets, we're talking about 0.15% allocation, increase in allocation for just pension funds. Not all of the other institutions that would jump on board. So we're talking about a relative scale, small amount for Wall Street. Now, again, back in 2016, that $100 billion would buy you the entire XAU and GLD, the two largest ETFs for gold. It would buy you the entire GDX, so all of the gold mining stock ETF, and the GDXJ. So you would more or less buy the four largest gold-related ETFs purely if pension funds doubled their allocation as of 2016 with $100 billion. I think that in that same video it says if it was $125 billion, you would buy all the gold miners. Flat out, you would buy them all. Every gold miner. And this is just an incredible sum of money, but yet such a small allocation. So this shows you the scale to which these institutions are actually underweight in gold. When you look at investor sentiment, so this is an indicator that's kind of looking since 2000, you know, kind of like the fear and greed index, but allocations towards gold and gold equities. You can see that we're more or less at a 2-decade low. You know, the last time we were there was really before that peak in the gold price versus the stock market back in 2000, and you know, again, following that, suddenly sentiment really shifted to the upside, and you can see again that we've got that double bottom forming, you know, with these 2 points. And you know, sentiment and price charts and things are all just human psychology baked into a chart. And you know, this is really starting to look a lot like a generational low for both sentiment, price action, miners, relative valuations, things like that. There's a lot of these pieces plus the macro backdrop really starting to line up and point to a similar picture. And again, the scale of paper claims, this is kind of like paper futures and you know, non-delivered contracts that get rolled over versus actual physical bullion. The line chart here is basically showing that you know, there's 280 times the paper claims over physical gold. And this is something to be very mindful of if you are looking in the gold market, being sure to find whatever product you end up looking at, making sure that it's physical and allocated, because there are a lot of paper products that do not physically have the gold behind them. And you can see in the bar chart, this is talking about volume, the amount of daily clearing, the amount of trading that goes on. We're talking about 3,250 tons worth of trading volume per day, and there's only 10.5 tons worth of supply coming in per day. So we're talking about just a 310 times, a disproportionate volume of trade versus the actual physical supply to meet that trade. And this is, I mean, the only thing that can move in this, the same as Bitcoin following a halving. When you have a supply shock or a demand shock, the only thing that can move is price, because it is that scarce, unforgeable asset. And this kind of shows you the scale to which the asset is actually claimed over and under-owned in the physical sense. So it kind of gives you that momentum there. And to put some actual numbers to it, this was a table that Dan Tapiero put out the other day, looking at if, some of these mutual funds, pension funds, banks, sovereign wealth, all these things, if they were to allocate 5% of their assets under management, or 2%, we're talking about thousands of percent over the 2018 gold demand. And 2018 was a strong year for gold, right? We've basically been in a 4 or 5 year uptrend since roughly 2016. And we're talking about thousands of percent increase in the total available gold that could possibly be bought. Now, the only thing that can move in this instant is price. And there's a lot of, as we've said before, there's a lot of macro things, both retirees, negative yielding bonds, no safe haven, deflation, inflation, and uncertainty. All of these things are currently in play, and all of these things through history have been very, very strong tailwinds for the gold market. So it kind of gives you a scale of why I think that there's so much money on the sidelines that needs to be and will be allocated. And it's why I think gold, more than anything, is probably going to suck the air out of the room, because it's woefully under-owned and significantly undervalued, especially relative to equities and other assets. And we can look at other things like other precious metals. Now, what we've basically seen, this is the four main precious metals charted up. We see that gold is currently breaking into its all-time high, and this is why I think it's important to kind of get a perspective on this at this point in time. We can see that palladium has basically never slowed down. It's been in an uptrend for since the early 2000s. Silver, we saw recently broke out above that low. I think that the low is most definitely in for silver. That would be my gut call. I would almost say that from all precious metals. But we normally see, and again, I've not been around for any of these precious metals gold market, bull markets, but my understanding is that silver tends to perform later in the cycle. And I think you can actually see this with the momentum in the gold chart right now. You can see that it's basically set these three significant higher lows before it's really almost just gone vertical over the last 12 months. Whereas silver has formed more of this basing pattern that has only recently started to break out. Now, gold could very well run much harder, and gold is kind of that altcoin. In fact, they're all kind of the altcoin to the gold. But this momentum, palladium has clearly had a significant run. It looks like it's in the process of consolidating. But I think that the momentum on gold is really going to start turning some heads, and that's why I really think paying attention to the gold market right now is a safe and sensible bet. And gold miners, so gold miners tend to function, I've heard them described as kind of a call option. They're, as we said before, there's not much point to owning a miner when the price of their commodity is going down. The converse is true when it's going up. They're kind of that leverage bet. We saw that they are relatively undervalued versus the metal itself. And this is just a chart over the last 12 months of earnings per share, comparing gold mining stocks, and we've seen an 108% increase in that versus the S&P, where we've actually seen a drop in earnings per share, which makes sense, particularly as COVID's really kicked in and impacted a lot of the earnings per share of these stocks. I don't expect this to improve. Whereas if the gold price keeps going up, many of these miners have reduced input costs. Things like energy and oil have come down. And they've actually had, the gold price has gone up, so their product has increased and their input costs have gone down. And since they've been in a bear market since, roughly the 2000s, 2011 I think was the peak, basically they've had to cut costs. Similar to miners, the bear market will weed out all of the weaker miners, and it leads to mergers and acquisitions and reduced CapEx and OpEx spend and optimization of their processes. So they've formed that long, strong, stable base, and now really is the time for those to shine. So there is a strong basis to actually owning miners as an alpha play over gold. And one very useful technique, there's the approach of just picking like a gold mining ETF like GDX or GDXJ. The other approach, which I found very useful if you're looking at individual stocks, is actually to just overlay the stock price with the gold chart. If you're looking at a silver miner, then you can look at it with the silver chart. And what I really like about this approach is I will use it to filter out. I am only interested in stocks that closely follow the gold price. Now, my logic behind this is that there's a lot of moving pieces that go into running a gold mine. There's all sorts of there's politics, and there's operations, and things go wrong with all of these mines, and you've got management and all that kind of stuff that comes into it. Now, if the stock price follows very closely the gold price, to me that says the biggest parameter in all of those things that actually matters is the price of their commodity, rather than anything else that's going on, performance of mines, or equipment failures and floods, or political unrest, or whatever else is going on, jurisdictional challenges. The thing that actually matters the most is the price of the commodity that they're selling. And to me, from my experience, when I use that metric, a closely following stock price, normally when I go and look at the comparison of how the mine is actually performing, and I use that as my filter, my first pass filter. I then go and look at how the stock is actually performing. I look at some of the fundamentals and read their reports and things like that, and the pattern most definitely emerged that the strongest miners follow the price, whereas the weaker miners, they tend to have charts that do not, or have some kind of deviation profile. So that's a useful tool that I've been doing, just overlaying it with the gold price and doing further due diligence on the stocks and the mining companies that actually perform alongside the gold price. Or as I said before, there's options like the ETFs and things like that can offer that single asset exposure on that front. Now, for further study and other resources, I could not recommend the various talks that Grant Williams has done highly enough. All four of these are exceptional, and I certainly learned a lot, not just about gold, but about the gold market, how it actually works, how it's performed through history, and why gold actually has the investment potential that it does. All of these presentations are exceptional, and I certainly recommend them. Most of them are on YouTube. I think that only Crikey is one that you'll have to do one where you do a bit of a Google and a search for. But overall, I couldn't recommend them highly enough. Sprott.com recently released an interesting article called A Very Fat Pitch, which looks specifically at miners, but also just gold itself, and how asymmetric the bet currently is. Lynn Alden is an analyst that I've recently come across who's been doing some exceptional work, particularly around the US dollar versus gold trade. And just some of the snips from above are from her, and some of the ideas are she's got a lot of really, really good ideas coming out. She was recently on Macro Voices podcast, and she was talking about her Bitcoin thesis actually on the On the Brink podcast with Nick Carter. And I would highly recommend both of those. I think she's got a really, really clean and fresh perspective. She comes at things from an engineering and an analytical background, so outside the finance world. So I think she's definitely worth keeping track of. And really, the Bible for all of this is the In Gold We Trust report. Now, there's lots of words. It's a very, very dense document. What I would recommend is if you do a Google and you find the In Gold We Trust report, they have a slide deck which has got all of their charts, and to be honest, you can probably get the vast majority of the message just by reviewing that slide deck. So that's a kind of a quick path to just seeing what's going on. So I hope this was useful. I know there's a lot of information in there. There's certainly a lot. Grant Williams most definitely will explain all of this a lot better than I do, and I would certainly couldn't recommend highly enough doing that further listening. But I think that now that gold has broken the all-time high, there is a very good chance that it will suck the air out of the room, much like what we saw with Bitcoin. And I think that the world is very underweight that and not expecting it. And it's something that I think is, for me personally, in my view, I know that being exposed to cryptocurrency is a higher risk venture. I believe in them to my core, but I also like to weigh down my risk with gold. I feel like it provides the same trade, the same fundamentals, and I think that the performance of gold is going to be quite remarkable. I think a lot of people are misunderstanding or not quite understanding the scale to which a gold bull market really performs. So I certainly I have it as that kind of, call it a rock, even though it's a metal. I have it as that investment rock where I know that I've got an allocation to something with very, very strong fundamentals, every fundamental reason to perform in this environment, and it helps weigh down the risk of my cryptocurrency portfolio. So I certainly see it in that regard, and I think that now that it's broken all-time high versus the US dollar, even though it's been there versus every other currency, it really is the time to be paying attention to it. So that's kind of why I thought I'd go over my thoughts and what's been going on in my head on that front. And be sure to grab me in the Discord room if you want to talk through any of these other ideas, and certainly let me know if you found this useful, because I do enjoy going down these other rabbit holes, and I'm always trying to share kind of what's on my mind and give you guys the best thoughts. So let me know how you found it, and thanks. I'll see you in the next one. Cheers.